Hello, good morning. I'm Fred Haddad. I'm a manager here at the World Bank. I manage the commercial counterparty risk team. I'm located here in Washington, D.C. We have a team of about 6 individuals in credit risk management. I have some people here in Washington, 2 people in Singapore, and 2 people in Chennai, India. And it works out very well. We have very broad coverage, and actually we have 24 hours of coverage. So we're covering the global markets all the time. I'm going to moderate the panel discussion today. We have 4 very distinguished speakers who have great experience, in the area of credit risk management, in the area of government guarantees, on lending and such. So we'll get to those in a minute. I would like to briefly introduce our panelists. To my right, we have Lalu Taruna Anugera. Palalu, and I've worked very closely with him over the past year or so, is the Deputy Director of Contingent Liability Management in the Ministry of Finance of Indonesia. He joined the Ministry of Finance in 1996, and initially he focused on banking policy and support within the commercial banking sector of the Directorate General of Financial Institutions. In 2007, he moved to the Director General of Debt Management as the head of Contingent Liabilities Unit in charge of analyzing risk, data recording, monitoring default risk, and reporting contingent liabilities. And I also know from working very closely with him that his team is very involved in providing government guarantees to state-owned enterprises, on lending and such. And his team has made great progress over the last year in really developing a state-of-the-art credit team. So he'll have a very, very good presentation. To his right, we have Mr. Emre Elmadag, who is the head of public finance and credit risk management within the Turkish Treasury. He has also recently been assigned as Deputy General Director responsible for receivable management and debt operations within Treasury. Credit risk management, which is one of his core responsibilities, has the responsibility of identifying, monitoring, and managing credit risk that can arise mainly due to the issuance of Treasury guarantees, debt assumption commitments, and non-lending facilities. So very, very similar to what Palalu's team does as well. Prior to being in the Turkish Treasury, he was an external consultant for the OECD in the Bond Market and Public Debt Management Unit, and was involved in different aspects of the program work of the Working Party on Debt Management. To his right, we have Mr. Mkulu Maseko, who is the Director of Credit Risk for the National Treasury of South Africa. Mr. Maseko joined the National Treasury in 2003 in the cash management section, where he was responsible for the development and improvement of new and existing cash management policies and procedures for the government, as well as the coordination of government-wide surplus cash management through the pooling of investment accounts. In 2010, he joined the credit risk section of the National Treasury. The primary activities here were to quantify and analyze the quality of the government's implicit and explicit contingent liability exposure, especially from public-private partnership projects, P3 projects, and in the granting of guarantees to state-owned companies, SOCs, including development finance institutions. And last but not least, at the end of the table, we have Mr. Fritz Florian Bachmeier. He also works for the World Bank, a junior professional officer in the Financial Advisory and Banking Department of the World Bank. He joined the bank in 2013. He advises governments on developing debt management strategies and managing risks from contingent liabilities. His focus is on helping clients develop systems to assess financial risks arising from guarantees and on-lending. So I think that's a common theme that you've heard with all of our speakers, very involved in government guarantees and on-lending. And Fritz has actually worked with a lot of our clients, a lot of the World Bank member countries. He's worked with Colombia, Indonesia, Pakistan, Paraguay, South Africa, St. Vincent and the Grenadines, and Turkey. And before joining the World Bank, he worked at McKinsey and Company. So we have 4 excellent presentations coming up. A very good mix of quantitative analysis and also fundamental credit analysis. These presentations go over the techniques that each of these teams use, and I think you'll get a lot out of it. I would like to ask everybody to wait until all the presentations are completed and ask questions at the very end. And the panel is very much looking forward to your questions. So please raise your hand. We'd like to get some questions. With that, I would like to turn the presentation over to Palalu.
Thank you, Pak Fred. Thank you for the invitation, so I can share the Indonesia experience in the government guarantee. It is many types of the government guarantee. Government guarantee for the social security, government guarantee for the pension fund, government guarantee for the minimal equity for the certain institution. But in this moment, I will focus on the government guarantee for the infrastructure project, especially in the risk measurement. This is the outline. Key characteristic. I will talking about the background, what the background of the guarantee issuance and guarantee scheme and guarantee programs. In the second, fundamental risk analysis, we will talk about the internal credit rating methodology, why we determine the internal credit rating to the assessment tool for the risk analysis for the risk measurement, and also what the function of the internal credit rating. We will give the example internal credit rating for regulated electricity, and for the third risk quantification, I will talking about the calculation of the expected loss, and also the calculation in the probability of default, guarantee fee, budget allocation, and reserve account. The background why the government issue the government guarantee is to encourage private sector involvement in infrastructure development programs and to attract the investor or creditor for credit worthiness. Indonesia needs the big amount to build the infrastructure development, but state budget has limited, so government want to invite the private sector to involve in the infrastructure development. So for the accelerate the program, the government provide the government guarantee. And then they are sharing risk between government and the investor or creditor. Hopefully, with the sharing risk, hopefully can decrease the cost, and at the end will decrease the tariff to the end user or to the people. I think that's the purpose of the government guarantee issuance. Basically, I can classify the government guarantee into the two schemes. The first guarantee, a credit guarantee and investment guarantee. In Indonesia, SOA in the credit guarantee, SOA or local SOA, which build the project, they will get the funding from the creditor under the loan agreement, and then government will issue the guarantee letter. And scope of guarantee letter is default risk. And also, government and SOA, state-owned enterprise or local SOA, have the recourse agreement. Its meaning is all of the guarantee payment will become loan to the SOA or to the local SOA. This meaning is the meaning of the recourse agreement. In the investment guarantee, the sponsor will establish the SPV, which is build the project, and also the SPV will get the funding from the creditor. And then SPV and line ministry will sign the cooperation agreement or power purchase agreement in the electricity sector. And then government and the SPV will sign the guarantee agreement based on the cooperation agreement. The scope of the guarantee agreement are the default risk and termination risk caused by political risk. And also, government has the recourse agreement with the line ministry, municipality, SOA or local SOA. This is the scheme of our guarantee. The current government guarantee program, we have the 4 program. One, fast track program phase 1. I think that this government has assigned to the PLN. PLN is the SOA in electricity, assigned to PLN to build 10,000 megawatt in power. And then government provide the full credit guarantee. I mean, full credit guarantee is government guarantee principal and also interest. Full credit guarantee. And government will step in if the PLN fails to serve its obligation, financial obligation. And the second program is clean water availability. This is partial guarantee. Government guarantee only 70% of the principal of the PDM obligation to the creditor. This is partial guarantee. And the third, fast track program phase 2. This is also government assigned to the PLN to build the 10,000 megawatt, and government guarantee the viability of PLN to fulfill its obligation under the power purchase agreement with the private power producer or independent power producer, and also guarantee against political risk in this program. And the last program is in the PPP. This is similar with the FTP2, but the guarantee party is too many. I mean, the guarantee party is ministry, line ministry or agency, local government, SOE or local or SOE. They also government guarantee to the guarantee party to fulfill their obligation under the PPP agreement. And the sector is many sector in the PPP. It can be power, water, toll road, railway, bridge, port, and any other. Why we determine the internal credit rating methodology as the assessment tools in the risk analysis, in the risk measurement, because in the previous methodology, we refer to credit rating agency, but in fact, not all the guaranteed party have been rated by the credit rating guarantee. So there is difficulty for us to assess if the guaranteed party is not be rated by the credit rating agency. With the internal credit rating also, we can setting the threshold for acceptable risk level in providing guarantee. I mean, we can set like maximal acceptability risk rating, which level the risk rating can be accepted for the guarantor. We can set up. We in Indonesia propose the maximal acceptable rating proposed in the level of 8. One level is its level is 2 knots. So rating reach around the 16 knots. And the third, strong capability in credit analysis is necessary for ongoing credit monitoring and credit risk mitigation. I mean, with the internal credit rating, we can also to monitoring at any time. We can assess the credit risk probability. So, and also the reason also Indonesia also have the different sector. This have different characteristic. We have the regulated electricity, regulated water. Also, we have the project like the project financing, and the next project in the pipeline. Indonesia also has ambitious in the infrastructure development program. So we think in the next project maybe they are in the seaport, airport, toll road, and the others. And also in Indonesia, different kinds of guaranteed party. They are line ministry, municipality, SOE, and local SOE. So with the internal credit rating, we can assess all of the sector, all of the guaranteed party. The function of the internal credit rating is to assess the level of credit risk to the government will be exposed to. I mean, with the internal credit rating, we can calculate each the credit rating. So we can calculate how much the risks can be exposed to the government. And then we can analyzing credit risk factor, regulatory risk, business risk, operating risk, financial risk, and also set up the risk mitigation plan. With the internal credit rating, also we can determine the probability of default, expected loss, guarantee fee, and state budget allocation. The very important thing in the build to the internal credit rating is how we set up the scorecard standard. I mean, fortunately, I get help from the World Bank team, Pak Fred, and also Pak Fred is our consultant in this area. So in this to build the standard scorecard, you must be to know all of regulatory framework. You also must be to know the business of the sector. You know the market position, the competition. So it is very, very challenging to set up the scorecard in the internal credit rating. Indonesia, in the set up the scorecard, is we refer to the Moody's methodology on also to the S&P methodology. We set up the base rating, and also we set up the modifier. The modifier is, the function modifier is to pull up or pull down or neutral from the base rating. We make adjustment in the scorecard. We make adjustment according to our condition, according to our sector. In the base rating, you can see the composition of the weighting is keep 60% and 40%. I mean 60% for the qualitative factor and 40% in the quantitative factor. But also we make the adjustment in the weighting according to the sector condition, and also we add the sub-factor management in the base rating, because we think the management is very important to be assessed in the base rating. So we add the one factor management in the base rating. And then after the base rating, we use the modifier. We put the two key factor. It's liquidity and financial policy. And then with the scorecard, you can get the result of the credit rating of the guaranteed party. In calculation of the expected loss, for the example, expected loss at the COD period. COD is commercial operating debt period in the infrastructure project. For the example, internal credit rating is BA1 at Moody's. The expected loss are calculated with the following formula. Its expected loss is probable default times exposure at default times loss given default. Probability defaults can refer to probability of default from default study of rating agency. If you can see this from the Moody's database, probability of default, BA1 for the next year, the probability default is 0.674. And exposure at default in the investment guarantee, it's realization of the equity and debt. Let's say the amount is 3.2 billion US dollar, and loss given default is 1 minus recovery rate. Recovery rate is based on our historical data, the recovery rate, especially in the water sector. The recovery rate is 50%. So we can calculate the expected loss, and we can result expected loss for the next year is 10. Yeah. 10 million 784 US dollar. In terms of the guarantee fee, Indonesia also in charge the one-time fee, arranging fee, front-end fee, and processing fee. That is, we refer to experience how the administration cost, how the consultant cost. If I hire the consultant to arrange the transaction, and also we charge the recurring fee every year. It's guaranteed fee. The fee calculated based on the yield spread. This is with or without guarantee. We use the market value approach. Guarantee fee is 50% times to spread of the with or without guarantee. 20% is like discount because the government is not profit entity, and also this is like to same with give the incentive to the private sector who's involved in the infrastructure development. So we can calculate the fee in this case in the 12 million and $800 US. And in terms of budget allocation, basically budget allocation is same with expected loss, but in Indonesia we use the 100% loss given default. It's different with the calculation of the expected loss previous, because why we use the 100 loss given default, because our portfolio mostly to the two for one party, mostly to the PLN. Our portfolio undiversified, and also we need a big amount of fund if the termination risk is occurred. So we can calculate the budget allocation at probability default times EAD times LGD. We can result the budget allocation is 21.5 million US dollar. Also, Minister of Finance also already established the guarantee fund reserve account. The source of the reserve account mostly from the state budget allocation. That is only for guarantee payment restricted cash. And if the unused budget allocation in the end of the year, it can be accumulated in the reserve account until its balance reaches a certain amount. The purpose of the reserve account is to make sure government has sufficient amount to pay guarantee claim in a timely manner, and to avoid the need for allocating a huge amount of fund in the state budget. I think that's all. Thank you.
Great. Thank you, Palalo. That was excellent. And again, we'll open it up to questions at the end. We'd like to get through all the presentations. We have 4 presentations. With that, we'd like to turn it over to Emre Almadag, who is also going to cover a very similar topic, guarantees and non-lending.
Thank you very much, Fred, and thank you for your presentation, Lalu. Hello, everyone. I am going to share with you the Turkey's experience on measuring and managing risk related to credit guarantees and on-lendings. There are mainly 3 sections in my presentation. First, I will give you some information about our use of credit guarantees and on-lendings. some definitions, some issuance sizes, and current portfolio size. Secondly, I will mention about how we manage credit risk arising from these facilities. And also in this part, I will introduce you the statistical model that we are using in Treasury. And I will conclude my presentation with some statistical graphs, which shows how successful our methodology is. Since these are historical graphs, I will also elaborate a bit on our pre-2002 challenges and how we overcame these challenges in the management of credit risk. So Treasury credit guarantee is a form of insurance that protects external creditors from the probability of a non-payment by the public entity. In the case of on-lendings, Treasury borrows the loan and on-lends it to a beneficiary institution with an agreement. And while Treasury services the debt to external creditor, the public entity has to service to Treasury. So the original debt is monitored under the central government debt stock. However, public entities' debt to Treasury is monitored in the receivable portfolio. There are some common features of these facilities. The beneficiary groups are the same for both on-lendings and guarantees, credit guarantees. The main beneficiaries are SOEs, public banks and development banks, municipalities and municipal administrations. And these facilities are just for foreign financing. We do not provide any guarantee or on-lending in the domestic financing. And ministry in charge of Treasury is the authorizing body of these facilities. And also we have a ceiling in the budget. And each year this limit is estimated by the Treasury, and it is proposed for the coming year's budget law. And one-time fee up to 1% of guaranteed and on-lend credit is charged to the beneficiaries. And there are some also differentiating features, like, for example, we have only partiality in the credit guarantees. We do not have any partiality in on-lendings. And we have a reserve account like the Indonesia has. And only undertakings due to Treasury guarantees are met from this account. And when we look at the debt stock effect, on-lendings are monitored under the central government debt stock. So when we issue an on-lending, we have an increase in our debt stock, central government debt stock. However, issuance of guarantees are considered as contingent liabilities, so we do not have any, we don't see any effect in central government debt stock. Before I move on to the measures that we implement in the management of credit risk arising from these facilities, I would like to give you some idea about our portfolio size. This blue line shows the guarantee and on-lending limit determined in the budget law each year. And total issuance sizes cannot exceed this limit. For the last 4 years, we kept this limit at $3 billion US. And these red bars are annual issuance sizes. And current stock of credit guarantees is $10.7 billion. And on-lendings and previously undertaken guarantees are monitored under the receivable portfolio. And current size of our receivable portfolio is $9 billion, of which $2.2 billion is overdue receivables and mostly arising from the municipalities. So in this slide, I'm going to introduce you the measures that we use while managing the credit risk arising from guarantees and on-lendings. The first and one of the most important ex-ante measure that we implement is Treasury do not provide any new guarantee or on-lending to the institutions which has outstanding overdue debt to Treasury. So before getting any new facility, institutions have to clean their credit history with Treasury first. And secondly, beneficiary institutions must have a sound fiscal financial capacity. For each application, Treasury assesses the beneficiary's financial capacity. So, as I mentioned, we have a limit application in order to control the risk arising from guarantees and on-lendings. A limit is set through in the annual budget laws. Finally, for the municipalities, we have an external debt payment account, which is an escrow account in a commercial bank. And before the provision of these facilities, they have to set up this account. And in order to meet the loan payments, municipalities transfer part of their revenues to this account, and Treasury regularly audits these accounts. And we have also guarantee and online fee application and partial guarantee practice. And we have a reserve account. We call this account as risk account, which is in the Central Bank of Turkey. Now we can move on to the model details. And most of the measures I mentioned in the previous slide is linked with this model. And the model in use was developed in 2006 by Treasury staff. One of the developers of this model is Çiğdem Aslan. She is now with the World Bank team. And in front of you, I would like to thank her for her efforts, invaluable efforts. And this model is based on Altman Z-score model, and Altman is widely considered to be the standard reference for the credit scoring models. And here the process starts with data collection and checking its quality. And besides the financial ratios or financial figures of the entities, from the Treasury information systems, we gather, for example, default status of the entities or payment performances, past payment performances, collection and recovery rates, and also cash flow projections of the entities are derived from these information systems. And most of the series are starting from 1980s in our model, so we have a huge database. Then we estimate the probability of defaults. This is the second step. Two types of default probabilities estimated. First one is probability of default in year t, given that there is no default in year t minus 1. And the second probability is probability of default in year t. This time there is a default in year t. So first type of default probability is estimated by credit scoring model. And the second type of probability of default, which is the current status of the entity is in default. So we consider that the financial figures of the defaulted entity is not a predictive for the coming years. So we use the past historical default statuses of the entities. So by using a transition matrix, we derive the default probability term structure. And by taking into account the cash flow projections and treasury funding curve and the entities' recovery rates, we calculated the expected losses. And the measures that we are using, like the partial guarantee, risk account appropriation, or guarantee on land fee, and the limits, are calculated based on the expected loss. So I want to give you more detailed information how we calculate the probability of default. As I mentioned, the first type of PD is calculated from Altman Z-score model. And the score model we use aims to forecast financial distress one period ahead through a linear weighted combination of explanatory variables. Here, X denotes the explanatory variables, and which are, in our case, the financial ratios, financial variables of the entities. And selection of financial variables is an important process of the model. And beta denotes the weights, and beta 0 is the intercept here. And in order to set the weights and the intercept, the parameters of this equation, we run logistic regression, and which use the maximum likelihood method. And with this process, we are getting 3 or 4 equations. And in order to calculate the best performing ones, again, we are using some statistical tests like cumulative accuracy profile, cumulative accuracy ratio, chi-square kind of statistical tests we are running. And we are getting an equation for each group of the beneficiary. And with this score, with this equation, we calculate the score. And with the by using this exponential function, we are calculating the PD for each entity. So in order to create a default probability term structure, we need another PD, which is the probability of default in year T, given that the current status of the entity is in default. As I mentioned, entities current status is in default. We do not believe that the financial data of the entity is predictive for the year after. So here we use the historical default status of the entities, and the formula here is dividing two consecutive defaults to total defaults. And by using a transition matrix, we derive the default probability term structure, and recovery rate and collection rate analysis are also playing important role in pricing the credit risk. Collection rate is the ratio of the actual collected amount to due amount. So recovery rates also taking into account if there is any rescheduling or restructuring, if there is any collection done at these stages, recovery rates also takes into account these amounts. And the data for recovery rate and collection rate and also cash flow projections are derived from the Treasury information systems. So now we have default probability term structure, we have cash flow projections, we have recovery rates and collection rates of the entities, and with the help of Treasury funding curve, we are calculating the present value of the expected loss from each entity. And now we can move on to the model outcomes. From the PD that we calculated from the scoring model, we assign credit ratings for each beneficiary. This is our rating scale. We set 4 ratings for non-defaulted institutions. If their PD for next year is less than 5%, we assign A credit rating for these institutions. If it is between 5 and 15, then we give B. And if it is 15 and 30, we give C. And if it is above 30, then the rating is D. If an institution is defaulted at least once in the last 2 years, we assign E or F rating for those institutions. So other model outcomes, guarantee fee and partial guarantee ratio, are calculated based on expected loss. We charge guarantee and on-lend fee up to 1% of the guaranteed and on-lend amount. The fee is charged upfront to the beneficiary institutions, and it is determined according to the risk level of the beneficiary, so it's a function of expected loss. And for the partial guarantee, it's a tool for us to share the risk with the creditor. The guarantee amount that is provided by Treasury is limited to up to 95% of the guaranteed and on-lend amount. And there is an exception here for the credits that is provided from international institutions and export credit agencies. We do not implement the partial guarantee implementation. We do not implement this partiality tool. Similarly, in partial guarantee ratio, we have a concave function, and the percentage of partial guarantee to be provided is again linked to the expected loss from the beneficiary institutions. And in the light of this graph, I would like to mention you about a challenge that we were facing before 2002 and in the 1990s, and how we overcame this challenge in terms of the management of credit risk arising from these facilities. Treasury has a long history with credit guarantees and on-lendings, and first undertakings due to Treasury guarantees took place in 1992, and it gained momentum since then. And starting with 2000, the undertakings due to Treasury guarantees was reached threatening levels to debt sustainability and also financing programs of the Treasury. So as a result, a new policy approach was adopted, together with the enactment of a law, which is the law number is 4749, which is a very important law. The name of the law is the Public Finance and the Debt Management Law. And together with this law, we introduced several risk management tools, like the ones that I mentioned in my presentation. And with these effective credit risk management practices, the picture started to change. Here, the blue bars are the guaranteed debt stock, and the red line is undertakings due to treasury guarantees. So as you see, although the debt stock is increasing during these years, undertakings due to treasury guarantees is going down significantly because of the increasing credit quality of the portfolio. And same story is supported by the risk account. The risk account was established in 2003, again after the enactment of this law. And undertakings due to treasury guarantees are started to be met from this account since then. This account is a ring-fence account, and there are certain revenues to this account, and only treasury undertakings can be made from this account. And the revenues, one of the revenues are the guarantee and on-lend fee, collections made from previously undertaking guarantees, and there is also interest income to this account. If these revenues do not meet with the undertaking amounts, then there is also a budgetary utilization to this account. And here in this graph, the pink bars are the budgetary utilization to this account. And as you see in the highlighted area, there is no pink bar because since 2009, the account is self-sufficient. So the revenues, non-budgetary revenues of this account is sufficient to cover the the losses arising from the undertaken treasury guarantees. And right now, a significant reserve is accumulated in this account for the rainy days. Finally, I would like to mention you about our disclosure policy about the credit guarantees and receivable portfolio. Treasury publishes monthly and annual debt management reports. And these are very comprehensive reports, consist of information regarding debt, cash, and receivable and guarantee management of Treasury. And it can be reached also from Treasury website. In this publication, detailed statistics on guarantees and undertaken amounts and risk account realizations also can be reached. Thank you very much for listening.
Thank you, Emre, for this excellent presentation. You know, as you can see, the first presentation focused more on fundamental credit analysis using some quantitative techniques, and Emre's presentation really focused more on quantitative methods of assessing and predicting risk. You know, with that, we'd like to turn it over to Mr. Makulu Maseko, who will also add a unique element in getting into some contingent liability issues as well.
Thank you very much. I just maybe for our presentation, just take you through, you know, how we look at contingent liabilities at the National Treasury. A few principles that we follow in terms of how we came up with our credit risk policy, and maybe get a bit into the methodology as well, in terms of how we look at the quality and we rate the quality of the exposure that government has through issuing guarantees. I mean, you know, I just like to mention that, you know, we basically implement the credit risk strategy within the asset and liability management division, and you know, we do credit risk policy. We have a manual. And we also play an integral part in the granting of guarantees to state-owned companies. We have recently also started playing quite a role in terms of PPPs in the country, although there is a specific unit that deals with PPPs, but we provide also risk assessment relating from that exposure as well. That's basically our structure, which is relatively small, and I'm not quite sure whether we are small compared to other countries. I know within ALM we probably the smallest unit within the division. But in any case, so over and above, just to mention, over and above contingent liabilities, we also look at counterparty risk in terms of the surplus cash that we keep with the banks. There's settlement risk that we look at in terms of government bond auctions. But the bulk of the functions that we do is basically contingent liabilities with regards to granting of guarantees, looking at also PPPs. As I said, we have implicit contingent liabilities, and as we go forward with our presentation, we'll just highlight what exactly we look at in terms of implicit contingent liabilities as well. Yeah. In terms of the implicit, I mean, the analysis that we do on implicit contingent liabilities, and it will become clearer as we go forward in the presentation. We also do an analysis of sorts in terms of, analyzing financial statements, looking at qualitative information. And essentially, it's implicit contingent liabilities from a South African point of view. We look at what you would call government-related insurance companies. There's also some work that we doing in the PPP space, but there's a lot of work that we intend doing in terms of improving that part of our work along with the PPP unit. All right. So in terms of implicit contingent liabilities, we generally, when we look at banks from a credit risk point of view, isn't really from a contingent liability point of view as yet, but it's rather from, as I said, the surplus cash that government keeps with these banks. So implicit contingent liabilities from our point of view is limited to these companies that you see there. So we also have an analysis that we do, but there's also a lot of work that we looking to do here in terms of improving our work with regards to that analysis. Right. So, I mean, in terms of the explicit guarantee portfolio, which is what I will cover for most of the presentation. We do an analysis, much as our colleagues with me here, looking at financial analysis, looking at financial statement. We look at the guarantee portfolio on an annual basis. And the idea here is to really highlight, challenges in terms of quality, where exactly challenges are. With regards to each specific state-owned entity, and also looking at the portfolio as a whole. We have I suppose you would call them a credit committee, which is called the Fiscal Liabilities Committee. We advise this committee on a quarterly basis in terms of the state of our exposure, what the amount is of our exposure, where issues are. And this report also links into whatever request would have come in. The committee meets on a quarterly basis, and these are the structured meetings, although generally they can have ad hoc meetings if there is a need. We also, in terms of sustainability measure, we don't have a specific limit that is linked to just contingent liabilities, but we have a measure of net debt provisions and contingent liabilities. The region, the Southern African region, has a 60% limit. We always have tried to keep this at 50% as South Africa, but it has become increasingly difficult, as you will see as we move on further with the presentation. Right. So these are the companies that we are exposed, or that we have granted guarantees. ESCOM, which is the electricity utility has the largest guarantee that we've granted. Some years back, we had difficulty with power supply, and ESCOM had to go on a massive infrastructure development program in terms of building new power stations and so forth. So they needed guarantees. I must say, though, for a number of years, at least until 2 years ago, their balance sheet was such that they could afford to borrow without using this guarantee that we had issued. But the environment has become increasingly difficult. So the principles that we use is that with every guarantee that we issue, we must make sure that we have an appropriate credit risk environment. All decisions take into account the exposure of government. We have an appropriate credit administration, and this is where we basically, the role that we play in terms of measuring, monitoring on an ongoing basis. As I said, we have this Fiscal Liabilities Committee, which and their mandate is making sure that our contingent liability exposure remains sustainable. Okay. We have a credit risk policy which is approved by the head of the Treasury. We have we had a standardized methodology which essentially we're trying to break that down into the different sectors, as you have seen the state-owned entities that I showed earlier. So we have the criteria that we use, so this would be more or less your ratios and indicators that you'd be looking at. And all these are looking at whether they'd be able to service this guaranteed debt. So as I said, the business risk indicators, and you'll see them now. We look at qualitative information. There's also financial risk indicators. And we went through a process a couple of years ago where we tried to, when we were reviewing our methodology, try to kind of remove some subjectivity, especially in terms of the financial risk indicators. These are the indicators that we look at. So from a business risk point of view, that is what we have. And from a financial risk point of view, that is what you have. You'll see those are fairly standard ratios that we would use. And essentially, when we went through this process of reviewing this methodology, we were trying to look at what would assist us in determining, I don't want to say probability of default because we're not there yet. So essentially, we're just trying to see whether these state-owned entities would be able to service their guaranteed debt. And if not, we then try and provide recommendations in terms of mitigation strategies. So at the beginning of this year, we went through a process where the first break that we did from the standardized methodology was to have a separate methodology for development finance institutions. We started with that one because I think it was a bit easier to do because we're already doing banks and they operate more or less in the same kind of space. It was a bit easier to start with the development finance institutions. And these are the indicators that we have for them. So essentially, an analyst will do all this, and based on this, they would provide scores. And this is how we, I know it might be a bit difficult to read, but essentially, the idea here was we rate each indicator from 1 to 10. Our base scoring table is 1 to 10, and that you'll see as we move forward. There's a slide that shows that. And we sat down, did some research, and had long discussions over a number of days and sessions where we were kind of saying, now, if you were to look at this particular or a particular bank or a particular development finance institutions, what would you assign a particular ratio if it comes out at that, and so forth. And this was a table that we came up with. I don't think those are the exact numbers, but essentially that's the idea in terms of trying to remove that bias when you score in the indicators. Right. You would then basically, once the scores are done, this is how we would apply the the individual scores to come up with a specific rating for a state-owned company. We have weights that we assign to each of the indicators, and these are based on how easy it is to measure, what's the priority, is that important in terms of assisting us to gauge the ability to service guaranteed debt. And so you would basically slot in the numbers there, and based on the calculations that we have done, you would get a rating for a particular state-owned company. Now, once that is done, we essentially consolidate all the companies that we have, and this gives us a consolidated or a weighted rating for the portfolio. Now, you'd see the numbers there. There are basically two columns, which in each column there's two sections there. And the idea is to more or less say which of the indicators or which of the ratios is driving the rating either up or down. And based on that, we are able to say essentially if you want to improve the quality of our exposure, these are the specific areas that you would need to look into, because that is driving the rating either up. And maybe if you want to have a bit more impact, the one that is driving the rating down, that is where perhaps you focus a bit more resources in terms of improving. All right, and then this is just essentially how our ratings, I think, in the past 2 financial years came. Essentially here, what we try and do is, based on the outcome of our analysis, we want to be able to say, from a risk point of view, you would want to be more exposed to this particular sector because the rating is maybe down there. So, and we then, when we provide this report to the Fiscal Liabilities Committee, this is to help them in deciding when they looking at requests, to say we are perhaps a bit overexposed there as a result, that might influence their decision and so forth. Right. This is the base of how we rate. So we have a rating from 1 to 10. It used to be the other way around, but some other clever people thought perhaps it's better if we go from 1 to 10, with 1 being extremely low and 10 being extremely high. We've had a number of discussions internally in terms of whether we can change this or not, but we thought perhaps let's focus just on the methodology and the analysis, and this would be maybe the last thing we change if we need to. All right. Now, for ease of reporting, essentially what we tend to do is we tend to just give the fiscal liabilities this, what we call in South Africa, the traffic light is called a robot. So we just give them this robot here from green, yellow to red, and they can see, what has been an improvement from 1 year to the next in terms of the individual state-owned companies. And they base their decisions on this. We report to the Minister of Finance, and this is part of that report, who also reports to Cabinet. So essentially our report tends to once a year at least go to Cabinet, where they can look at the quality of our exposure, and they can, we also give them recommendations in terms of mitigation strategies and so forth. All right, this is what our exposure was. So to the total guaranteed amount is the actual amount that has been issued as guarantees, and the total exposure amount is what has been used by the individual state-owned company. So in 2013-14, which these are the numbers that were published with the budget, there was 209 billion rand, which is about $2 billion exposure. And as I said, it's becoming increasingly difficult to stay within the 50% limit that we set for ourselves in terms of net debt provisions and contingent liabilities. And you'll see, I mean, while we are worried about contingent liabilities as well, I think net debt has also played a significant role in terms of moving that up. And this is more in line with South Africa's. We have a significant infrastructure development, or should I say a very ambitious infrastructure development program. And while our debt has been increasing, we've also had to increase our guarantees to state-owned companies who also play a significant role in terms of that program. And I think that's that. These are just concluding remarks, but essentially I've said everything there is to say. Thank you. Thank you.
Thank you, Mkhulu. Another excellent presentation. Our last speaker is Fritz Bachmeier, who also works at the World Bank, and he has worked very closely with all of our panel speakers today, and we'll have some a very good overview to end the panel discussion.
Thank you very much, Fred, for the kind introduction earlier as well. We at the World Bank Treasury had the privilege to facilitate a peer-to-peer exchange between South Africa, Turkey, Indonesia, but also Sweden and Colombia. And following Emre's example, I wish to thank Lars Herngren from the Swedish National Debt Office, who facilitated the exchange with our Swedish colleagues, and that was very valuable for the panelists and also our Colombian colleagues. We have learned a lot through the experiences, the very rich experience that we've heard about here from countries that have been doing quite a lot already in this area in managing and measuring risks from contingent liabilities. And by intensifying this conversation with other partners and countries, we learn how important of an issue that is for many other countries that are in earlier stages of the development in this process that might not have systems in place like Turkey, South Africa, and what's currently being developed in Indonesia. So we want to support that work in building those systems through advisory services that we've partnered with Fred's team and worked in Indonesia, training opportunities, but also some guidance. And one element of that is a paper that is intended to guide countries through thinking of developing a risk measurement process. And that's what I would like to share a bit about today. When looking at the different country experiences that are very heterogeneous, we see that the process of developing such a system follows some commonalities, if you will. First, you need to understand what are the key characteristics that could influence the approach that you take. So to say, assess your situation and draw a baseline on which you can then start with analyzing the specific risk drivers of your guaranteed entities in the respective sectors that you are exposed to. Then the next step can be translating that risk analysis into quantifiable measures, which could then be a basis for designing risk management tools and risk mitigation instruments. Now I will talk a little more, but not much, about these 4 steps. First, when you want to start with building that system, you want to understand what are the characteristics of your guarantee portfolio, what's the size, what type of entities I'm exposed to, what is the probable evolution of the system. We've heard, or of the portfolio. We've heard from several countries that a push to do more infrastructure financing does also create a pressure on treasuries and the risk managers to underwrite guarantees to leverage private sector sources. Countries need to understand clearly what's the risk exposure that they are taking and how is that different from other market participants. By owning state-owned enterprises who provide vital services, the exposure that you have as a government is very different from an investor who would maybe in the open market transact credit risk and act as a creditor. You would also need to understand as a first step what are the resources and the capacity that you have in cases where managing contingent liability risks is part of the debt management offices. You might not necessarily have a match of skills that you need in terms of credit risk analysis and the experience that dominates in the debt management offices. You would also need to understand what's the commitment of policymakers to really invest time, money, and effort in developing a system. And what is very important that came out in the discussion here, what's the kind of data you have available, historic information on credit events and the prevailing characteristics of the guaranteed entities at the time. In the Turkish case, we've heard that the Turkish Treasury has collected data for many years and decades, which allowed them to build their own system and calibrate that statistical model. In the Indonesian case, we understand there's not a rich history of a collected history of credit events and information on the guaranteed entities. So you wouldn't, and as Palalu elaborated, they would then need to rely much more on external sources, say from rating agencies. The next step would be the meat of the story, if you will, which is the actual risk analysis to be undertaken. And there are different approaches that are available, and we've heard from our panelists that in the case of Indonesia and also South Africa, a credit scoring approach has been chosen for reasons that are part of number one here in this process. In the Turkish case, we've heard that a statistical model has been developed, but there are other approaches too, such as structural models, which base insights on option pricing theory, or the simulation of financial performance, which is one of the approaches that the Swedish National Debt Office employs. Once you have a grasp on understanding what is the fundamental risk I'm taking, in many instances you would want to translate that into numbers. So in terms of the South African example, well, a 7 in this internal credit rating scale, what does that mean in terms of different types of target measures? It could be expected loss, as we've heard from Turkey and also Indonesia. It could be market values, which also came up in the Indonesian case with respect to charging a guarantee fee. But then there are other other target measures, such as unexpected losses, meaning what am I likely to lose in an adverse event, or a maximum probable exposure, which if you've followed the Turkish example, where the Turkish Treasury only guarantees borrowing in foreign currency, could be some stress applied to the exchange rate. And then we've seen two primary approaches, I think, to then actually quantify those targets. One would be using price differentials, which Palalu talked about, saying, well, I just understand the market value of the guarantee as the difference in yields between guaranteed and non-guaranteed debt. Then the second approach would be, if you will, a little more fundamental and less reliant on available market information, the estimation of default probabilities and using those default probabilities to then estimate expected losses by multiplying default probabilities with the exposure and an estimate for loss given default. Once you've undertaken this very extensive exercise of understanding your risk and maybe translating that into quantifiable measures, well, where you really get the benefits out of the process if you actually do something with that, and that's the fourth and last step, applying those insights in risk management. And we've heard many examples already from our panelists. I think setting guarantee fees that are based on the specific risk that you're taking, one of the most prominent examples, but setting guarantee limits, as in the case of Turkey, but also Indonesia has been mentioned, partial guarantee coverage that came up in Emre's presentation, setting aside money in a budget, number D, and then linking that to point E's, appropriating for a contingency reserve account that the South African Treasury at the moment is thinking about, and using the insights in risk reporting and monitoring. And that was very briefly what I wanted to talk about. So if in your country you think about developing a risk measurement system or have something in place that the insights from this panel make you think about improving, we are very interested in entering into the conversation. And one thing we will certainly do is when this paper that is detailing this process that I've been talking about will be available, certainly share that with you.
Thank you, Fritz. That was another excellent presentation, a very good summary and wrap-up to what we heard from our other panelists today. At this point, we would like to open this up to questions. If you would, maybe put your hand up and state your name and your position, and we would be happy to answer your questions at this point.
Hi, I'm Lior, the head of Risk Management Department in the Ministry of Finance in Israel. I would like to comment on the calculation of the guarantees fees regarding looking at the spread between the yield of the entity to the yield of the government. I think it can introduce several challenges. First, the yield of the entity may capture also premium liquidity and not just credit risk, especially if we are talking about a bond for a long-term maturity. Maybe a good solution will be to trying to quantify what is the liquidity premium and to deduct it from the yield spread. Or maybe a different solution will be to look on the CDS spread, so as a measure of pure credit risk. Secondly, even in case of a liquid bond, from our experience at least, when we are talking about essential companies, we see that there could be implicit guarantee introduced into the yield of the bond. So in order to capture the risk from the government perspective, sometimes it can be a little bit challenge to look on this yield because the yield is already measuring some of the implicit guarantee that will be produced to the entity. And third, and maybe a substitute formula for calculating the spread will be actually to present value the cash flow by the yield of the entity and the yield of the government instead of looking on only the difference on the spread multiplied by the notional. Sometimes it will be a more accurate formula. Actually to cash flow the present value by the yield of the entity and the yield of the government. And in case of long-term guarantees, sometimes it's a little bit more accurate than looking on the shortcut formula.
Thank you. Excellent questions. I think there were three questions there. Maybe we should just go through each one individually. The first was the liquidity premium that you may see when you're comparing the yield on a government debt versus the debt of a project. The debt of the project, you may have a liquidity premium because the bond is not traded or the debt is not traded, and maybe that should be factored into the pricing. Would any of our panelists like to entertain that? I know, Palalo, we've discussed that when we've been in Indonesia. I know it's something that we've thought about when coming up with pricing schemes. If a bond is not traded very much, there definitely will be a liquidity premium, and I think it is something that needs to be taken into consideration. And I think it is something that you've thought about, in Indonesia. But I think it's just an emerging area. I think not many of these guarantees have been given for these very projects that have very little debt issued. So I don't think it's an issue that's really confronting them all that much. But would anybody like to comment or?
I can say something. I mean, very good point by Lior. I mean, in order to calculate the guarantee fee with this kind of structure, you need to have a very deep and very liquid capital markets. I mean, because the pricing is very important here. If you could not get a good pricing, then your guarantee fee, or when you charge a guarantee fee, is going to be wrong. And for the public projects, we do not want to be hard on the public entities because they are conducting public investments, and there is a social side of these investments as well. So, for example, in Turkish case, we are charging guarantee fee up to 1% of the guaranteed on lent amount, because sometimes the expected loss arising from these institutions can be higher than 1% of the guaranteed and on lent amount. However, law limits us with the 1%. So we would also like to charge the guarantee fee like the Leo said, or the expected loss that we are calculating with our models. However, as I mentioned earlier, these are public investments, and we also should think about the social side of the projects.
Yeah, I think another way to think about it is if you have a credit team, I mean, there may be a liquidity premium, but if you're performing your own internal assessment of that credit, you're going to come up with your own internal credit rating, and then you can benchmark that rating to other debt that's trading to look at their yields, right? And then if you do that to enough other counterparts, you'll come up with an average yield, and that should start to factor out that liquidity premium a little bit, maybe not completely, but I mean, maybe that's one way to make an adjustment. Any thoughts? I think the second question you asked was is almost the reverse, right? It's the reverse of that. When you're looking at a project that is owned by a sovereign or a state-owned company or enterprise, there may be an implicit guarantee. There's not an explicit guarantee, but there's an expectation within the market that if that entity needs help, that the sovereign will come and help and either provide it with cash support or even step in to help make a debt payment. And again, I'd like to open it up to the panel. I mean, how do you analyze that risk and maybe adjust pricing to reflect that influence?
Yeah, well, I suppose it's what we did, which was we just did a standard analysis looking at the differential in yields between the bonds that were explicitly guaranteed and those that if you might say implicitly guaranteed, and see what the spread is between the corporate yields. Or looking at ESCOM, for example, you might look at their bonds that are explicitly guaranteed, the yields on those, and looking at those that are not explicitly guaranteed, and see what the spread is, and that might assist in how you come up with the fees. But I mean, in our case, we basically have a standard fee across the board, and that was essentially how we got to that fee. We basically look at what has been guaranteed, what are the yields on the bonds, on the SOE bonds that have been guaranteed, and what are the yields on those that have not been guaranteed, and that was used to determine what the guarantee fee would be.
Very good. Yeah, so I guess, focusing on that delta between what is explicitly guaranteed versus what many may think is implicitly guaranteed can yield some information. You still may have some, some impact from the implicit guarantee, but at least you can start with that delta.
Sometimes you can also look, on the credit rating agency, because they sometimes rated the company standalone, and then you can look on different companies that is rated the same.
That's right.
And you can see also what is the difference in the yields for those spread. And
That's right. Basically, you can use the same technique for both questions to sort of benchmark. Very good. And then the third question, yeah.
And I think what your question brings out very importantly, that the type of measure you apply very much depends on what you actually want to do with it. If you want to charge a guarantee fee, I would argue, well, then you should only charge for the delta in risk mitigation that you offer the entity, because otherwise, well, the entity applies for a guarantee and then you suddenly charge them also for the implicit part of the guarantee, then they wouldn't go for it, and you charge them for more than you offer additionally. While when your goal is rather to understand the risk the government is exposed to, I very much agree, and I think that's one of the reasons for the work that we're doing, that you say, well, the shortcut of relying on market prices might not always be the best choice, right? And you, as a government, need to fundamentally understand the risk that you are taking, because it can be very different from what is reflected in market prices.
Yeah, that's a good point. I mean, as a sovereign entity, you have resources that private creditors do not have, and I think the point you're making, Fritz, is that really your risk may actually be less than that of a private creditor, because you can be
or much higher.
Yeah, that's true. Yeah, depending on the situation. And then your third question, I think, and I might need some help. It was using a cash flow method of pricing. Maybe you could restate.
yes, instead of looking on the spread and multiply by the notional amount, you can actually take the cash flow itself and to discount it by the yield of the government and the yield, and the difference between the present value of the cash flow will be the fee in dollars. But
That's
sometimes it's a little bit more. We use the same the both technique, and sometimes we see little bit differences, especially if depend on the curvature of the curve. So.
I mean, that's a very interesting way of doing it. I don't have any. Again, I'd like to open it up to the panel. Has anybody priced using that method? But very, very interesting. Thank you.
Björgvin Sigvardsson from the Central Bank of Iceland. I have one question here, and it has to do with statistics, disclosure, and risk management of state guarantees. I noticed that the countries, they showed information on outstanding stock, and of course that is important. But I think it's also important to be able to see the redemption profile of the state guarantees. We are showing, most of the countries, they are showing the redemption profile for their debt. But what about state guarantees? This is something that I would like to.
So when you say redemption profile, you mean
redemption profile for the state guarantees as a whole.
So that's an excellent question. So
Yeah.
if I understand you correctly, the question is, with the state guarantees, what is the actual liability, right? Is it, how do you define it? Is it in notional terms? Is that?
Yeah, well, what I was trying to figure out whether you track on regular basis redemption profile for state guarantees on nominal. We can use nominal, yeah.
Nominal? So I think that was, Emery, I think that yeah.
It's a very important question, and in Treasury, as I mentioned, we are publishing annual and monthly debt management reports, and in these reports we are also giving the statistics, the projections for the guaranteed debt stock. And for on landings, they are also monitored in the central government debt stock, so it's already there. It's very important because these are one of the major explicit contingent liabilities, and markets should know about the size of these numbers. So Turkey is publishing this information in the website of Treasury.
So Emery, the measure that you use is the notional value, is that right?
Yes, yes, it's the notional value.
Fritz, did you want to?
Yes, and I'm obviously not Colombian, but I might speak for them. What I've seen in Colombia is that they report the redemption profile by rating of the entity.
Very good.
Yeah, from a South African point of view, what we report on is a redemption profile, although it's the redemption profile of the state-owned company debt, so it wouldn't be specific in terms of which the guaranteed debt, but essentially what we would report is what would be the debt, the redemption profile of the debt of the state-owned companies, and that should provide, I suppose, some level of information in terms of exposure to government as well.
Very good. Any more questions? I know we're standing between every. Oh, good, yes.
Yeah. My question is related to the internal credit rating agency, or the how you perform internal credit rating. Is it for your on-lending operations or for the guarantee? Because say for instance, an SOE or a corporation would have a very low credit rating. Does that mean that you will not be providing on-lending, or you will be guaranteeing their loan, but you will be charging a higher guarantee fee, or because it's well, it's a disincentive in the sense that if you have a higher or a low credit rating, then you will not be getting a loan or getting a credit either from the government or from the public or from the private institution. But at the same time, it means that you really need that facility because, I don't know, maybe because cash flow or the risk is higher, so it means that you need guarantee. So how do you actually use the internal credit rating?
Would anybody like to entertain that question?
It's a very good question because, for example, some institutions, some companies, state-owned companies, they can get E or F rating, but they can apply for treasury guarantee or on lending. In Turkey, there is no rule that we cannot provide the SOEs which has E or F rating, the guarantees and on lendings. However, as a credit risk management department, when we assign credit rating, a low credit rating for companies, and the issuer, the front office, cannot, do not want to issue guarantee according to our low credit rating assessment. But still, if it is a very important project, there is no obstacle in front of issuing any, issuance, even if the entity's rating is very low.
Yeah, I mean, generally what we have in terms, even the terms of reference for the fiscal liabilities committees, each individual guarantee request, is looked at on its own merit. So, and we look at a whole number of issues. The front office, if I may call them that, who come and present this request would have a whole host of reasons why the guarantee should be given. We will present our findings from a credit risk point of view, and the idea is to give the committee all these facts. Most of the time there's a social element to the projects that the state-owned companies want to undertake. But the idea is to enable the committee to take all this information into account when they make their decision, so that they know at the end of the day that, look, we might be giving this guarantee, but we give it knowing that there's a high risk related to the state-owned company, but the social aspect outweighs the credit risk at the moment. There are cases where we have presented our findings and the committee has gone based on the credit risk findings because, it outweighed the other issues that were being looked into. So it is all different, and which is why we do not want to have a set document which says once an entity is rated at this level, we will not give a guarantee, because there's a whole host of issues to consider.
Also in Turkey, we have a room for this kind of entities and this kind of projects. The portion of D, E, and F rating institutions in Turkey cannot exceed the 10% of the total portfolio. So, as a government, you have to support these projects, whether the entities, credit quality is not good. So, this is why we put aside this kind of, for this kind of instances, we set aside a 10% limit. And this limit is a performance target for Treasury. And these performance targets are audited by Court of Accounts each year. So we are very strict with these limits.
Yeah, I would just add, I recognize there are situations where you may need to provide a guarantee, even though your internal assessment is that the entity is not very creditworthy or may have a very low rating. And having gone through that exercise, it at least allows you to manage expectations, right? You can help senior management know that, look, this entity is very weak. There's a high probability of financial assistance. And also, you can be a step ahead because you can really have really good surveillance, and you can work with that entity, try to identify problems before they actually happen, and try to keep them out of trouble. So, even if you know that it's a poor credit, it can be a very worthwhile exercise to come up with an ICR and to share that information. I know we're the last thing between you all, everybody, and lunch. Maybe we'll take one more question if there is one, and then break after that.
Hi, my name is Jose Moreno. I'm a consultant.
There's a mic.
I'm Jose Morel. I'm a consultant. My question is for Indonesia. I noticed that you treat line ministries as one of the guarantee parties. Line ministry being part of central government, I was wondering how do you treat them compared to SOEs or municipalities?
Good question. In the Indonesia case, for the guarantee parties, the line ministry, we treated the exception. In the PPP project, let's say in the recourse agreement, for the line ministry is exception. I mean, this is one pocket. One pocket is it's government. So if the Land Ministry cannot fulfill the obligation, the Ministry of Finance is not charged the Minister of Finance is, doesn't have the recourse right to the Land Ministry. I think it is the for exception. Thank you.
Great. Well, thank you very much, everybody. Excellent questions, and most of us will be around, the rest of the day. If you want to ask us any questions, we're happy to speak with each of you. Thank you.
And lunch will be served at the same place as yesterday. And if you haven't been there, there's staff outside who will guide you there. It's on the same floor as the Preston Auditorium in the center of the building.